Hi everybody, welcome to another update on the stock screener. We are going to look at Perpetua resources because someone asked for it. Why is it down 22%? I am very curious to see why it is down 22%. And probably it has something to do with this update. But let's start from the beginning. Balance sheet. Current assets. 20 million, probably US dollars. Normally it should be somewhere here telling us that it's either US dollars or Canadian dollars. Yeah, United States, okay, so it's US dollars. 21 million. And liability is 12 million. We have a tiny bit of cash. Okay, this is in US dollars, so like this. Shares outstanding. Where's the shares? Fully diluted shares, 73 million. Okay, so we have 670 million market cap. Okay, that's all I need to know from the balance sheet. Let's go to the project itself. Let's start with the update because that gives us a lot of information. Okay. Let's just go here. Okay. Gold ounces. 1.8 million ounces. Yes, 1 to 4. So the total is 15 years. So where do we start? Let's say they go in production next year, but that's much too early. But anyway, I only have to 2041, so let's say next year. Gold ounces is 1852 million divided by 4 years. And then we go to 4.2 million for all the years. So 4.2 million is sum of this here 1, 2, 3, 4, 10, 16 years. It's only 15 years. Yeah, so I can just move it up a bit, move it here. And here, let's just take some number. And I get 5 million. So it's lower. Almost. I'm not going to look at the feasibility study. I'm just trying to give an estimate. So it's much lower. Okay, about this level. So a lot of gold in the 4 years, and then it goes down. Okay, antimony, £1 million. They like to use pounds. I don't like that because I look at tons. Okay. 69 million pounds of antimony. 69 million pounds divided by 4. That's in pounds, but in tons, it's going to be divided by 2204. Okay. And then here we have 106 million pounds. So here it's 106 million pounds divided, that's in tons. So is sum of all of this, and we need to get to 48,000. What is this? 106 million pounds. 18 million pounds. Oh, wait, we're here. 69 divided by 4, and then tons. $106 million. That's in tons. Okay. 48,000. And this is 75,000. That's too high. That's weird, eh? That's very weird. First, it's like very high production, and then it halves. And this is even worse. First we have 70 million pounds, and then for the rest of the years it's like nothing, only 40 million. So this is much lower. Yeah, about this way. So a lot of antimony in the first 4 years, and then nothing thereafter. And this gives about the same. Okay, so that's the production profile. Then Recovered gold annual average 463,000. Okay, and then here 296,000 for the life of mine. Okay. All-in sustaining cost net of byproduct is 435. Okay. 435. This is byproduct gold. So if we look at costs, this must be gold ounces, all-in sustaining cost, and like this. And then we go to 756 for the life of mine. Yeah, this is irritating because then I need to estimate what it is going to be in between. Let's say 900. And then is average of this 756, maybe 850. Yeah, 880. Okay, about this number. Okay, we're almost there. Initial capital 2.2 billion. 2.2 billion. That's a lot of money. And let's say some capex just for fun. They need to drill something and all of that. Okay, 2.2. We're talking about a pretty big operation, revenue 1.5 billion. Yeah, 1.5 billion, 400,000. I would give it depreciation of 150 million. Okay, and then interest. Yeah, they need to finance it, of course. So let's say 10% interest rate, 200 million. And construction time, so interest rate stays the same. And they get about, yeah, of course, the antimony price is not 22,000, so it's 50,000, maybe for a few years. Does it actually change something? Yeah, revenue went up a bit. So we have net income. Wait, net income is revenue minus cost. So it does do something. You can see the net income does change a bit. 1.5 billion net income. So that's odd. Maybe we should add the tax rate first. Let's say 30%. Okay. And now we go for antimony 50,000. So 1 billion per year. That means they will pay the capex back in about 3 years, 2 to 3 years. So the interest will go down like, let's say 150, 150, 0, like this. So it's a good project. There's some cash flow that's coming in. Okay, next up. Okay, so these are the numbers that they used. This is the feasibility study. NPV 5%. Is 3.6 billion. Okay, so why are they saying spot is 21 pounds? Because 21 pounds per ton is, okay, so 46,000. Okay, so they think 46,000 for antimony. This is at spot, and 2,900. Okay, so the NPV 5 is 3.6 billion. Is that correct? If I do here 5, yeah, 3 billion. So my numbers are correct. Okay, payback, yes, 2 years. Economic sensitivities, okay, we can play with that ourselves. We don't need these numbers. Okay, let's take a look. So this is the situation right now. I use 13% discount rate. Is this a PEA or a feasibility study? Let's see. Construction decision this year. I want to know how long it takes to build it. Let's see. Not a lot of timelines. It's a feasibility study, okay. So that means we're almost there to build it. But they don't give any timelines. That's a pity. No numbers about when they are going to construct it and how long it takes. Okay, and then not. Doesn't matter. let's say they go in production in 2027. So is there any upside? This looks like a dangerous project to me. Very dangerous. If the capex goes up by, let's say, 50% or 30%, this could easily go like this. Bam. No upside. Just because this is high capex. Next up, what could also happen is antimony is now very high, but in 4 years from now, just when they start producing it, this could go back to 25,000. So let's say we go back to 25,000. Okay, it doesn't change a lot. So apparently Perpetua Resources is absolutely no leverage to antimony. You can see it here. We went from 50,000 to 25,000 and nothing changed. So this is 1.2 billion and it went to 1 billion. So nothing changed. And what's the market cap already? 700 million. 1.2 to 1, that's okay. That's about 20% of this. So there's a tiny bit of leverage, but not a lot. So it's more a gold play. If gold goes to 3,500, what happens then? Yeah, absolutely. So more leverage to gold than antimony. So is this an antimony play? No, I don't think so. This is more a gold play. So everyone buying Perpetua Resources for the antimony? I don't think so. Okay, 46,000. Let's say it goes back to 25,000 in 2028. Gold. Yeah, let's just choose this gold price for now. And you can see that there's absolutely no upside. Maybe it can go up 10% depending on the capex. This is a very dangerous project. Let's use 10% discount rate. Looks better, but look at the gap here. Capex is much too high for the amount of upside that you get. There is upside, but if we get a capex blowout, as I said, 2.8, bam, it goes down. This is like horizontal minerals where you have big capex and they will never make money anymore. Yeah. Okay, so this was Perpetua Resources. Just look at this. Just look at this. Do you want to buy this? I don't think so. Better is to buy things like Soma Gold, where you have a much better upside. Let's show you that. Look at this. Immediate upside. In 3 years paid off, and then 3x upside based on the market cap. Without any negative cash flows like this one. Negative cash flows, and you need to wait 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11 years to get back to your enterprise value, and then there's no upside. Soma Gold, 1, 2, 3, and 3x upside. So easy, very easy for me. Avoid Perpetual Resources, very high capex, no leverage to Antimony at all, and completely overvalued. Also, 600 million market cap, they cannot finance it. 2 billion capex. How are they going to get to 2 billion capex? They don't have enough market cap to do that. So I think this is going to go down pretty much. And I'll see you in the next video.